This is the WealthAbility for CPAs show. Better clients, better practice, better life. Here's Tom Wheelwright.
Welcome to the WealthAbility show for CPAs, where we're always discovering how to build better clients, a better practice, and a better life. Hi, this is Tom Wheelwright, your host, founder, and CEO of the WealthAbility Network. So inflation, it is everywhere. It's probably higher than what the government says it is. We all feel it in our pocketbooks, and our clients are feeling their pocketbooks. So today we're going to discover what to do about it. How do we deal with inflation when we've got high inflation and the markets are all down? So you can't combat inflation by higher investment returns in the market because the market's down. So you actually have down market and you have high inflation, which back in the 80s, we used to call this stagflation. Haven't seen that term really being used much, but I think there's just a lot of repression on that term. But in order to talk about this and talking about inflation as a tax as well, because it is really an insidious tax on the poor and the middle class. We have Garrett Watson from the Tax Foundation. Garrett's been here before. And Garrett, welcome back. Thanks for having me. And just a little bit about your background again, for those people who don't know you.
Yeah, so I'm a senior policy analyst over at the Tax Foundation. And as an organization, we concentrate on state, federal, and global tax policy. We focus on both education and policy work to help policymakers, the media, everyday taxpayers just know about more about our tax code in order to push it in a more simple pro-growth direction. I concentrate on a lot of our federal work, and I've done a little bit of state work as well. And as you've mentioned, of course, the inflation situation has kept us busy in DC, combining that with all the news we've seen on the economic side over the last year.
So let me start with this. Let's just actually start with inflation as a tax. Because if you look at, let's say you have a person who's on a fixed income, and they've got an annuity coming in, and the annuity is paying 4%, and inflation is 10%. So they're literally losing 6% annually on their investment, and they're losing purchasing power, which is like a 250% tax. Do you look at it the same way, the Tax Foundation?
Yeah, I think that's a good way to think about it. And that's often consistent with how people view it in their everyday lives. It matches the intuition. When you look back at the high inflation levels that we saw in the 70s and early 80s, and now, it's true that both prices and say wages or the returns to certain investments are going up in nominal terms, but they often lag the increase in prices that you're paying elsewhere. And what that translates to is a lower real standard of living over time. It also creates a lot of unpredictability, which people really makes it a lot harder for financial planning moving forward, because I think as we were just chatting right before we started here, the price increases on certain goods and services are not linear. A lot of goods and services, say food or gas, may increase much quicker than overall inflation, making it even harder to plan. And of course, for workers, that's really hard because it requires several maybe uncomfortable conversations with their bosses about wage increases in order to match this inflation, and or taking on more risk to get more returns in the market.
Well, and then if you put pressure on the wages, don't you then isn't it a spiral?
Yeah, exactly. Yeah. So it's self-reinforcing, right? As folks expect inflation to happen and demand higher wages or move to jobs that command higher wages, it's going to force feed more demand into the economy. And then we get stuck into an inflationary spiral that's very hard to get out of. Right.
So, all right. So we've got this inflation, and do you have projections? What's your projection as far as is what the Fed is doing? Is it going to be enough? Can the Fed actually stop the inflation? Or, that what I call magic money theory. When you look at Stephanie Kelton and her gang that says, look, you can keep money putting in the money economy, and then you can put the brakes on by taxing money out of the economy. And theoretically, sounds great. Okay. Only what's wrong with that analysis, Garrett?
Yeah, I think big picture, the attitude everyone should have, especially policymakers and even especially the wonks, is a bit of humility on what might happen moving forward. Because a lot of folks were so confident that this inflation either wasn't going to happen or was going to be transitory and very short term, because they were so used to the low inflation environment we had prior to the pandemic. And what we saw with all the additional spending and with all the supply chain issues with the pandemic, that their expectations about that were wildly off. I mean, a lot of folks were not dreaming that we'd have anywhere close to the inflation level of 8.5% or even higher that we're seeing now. And so I think that really does mean, from a policy perspective, we need to be very humble and conservative in the sort of broad sense about the direction of inflation moving forward. There is some very early indication that maybe things are softening a bit thanks to the Fed's rate hikes. But I think the big pickle that the Fed is in now that they're sort of trying to catch up is, how do you try to dampen this inflation without what is known as a hard landing or a recession? Right. We're already seeing the markets, of course, which were already hitting all-time highs before these rate hikes, starting to trying to panic a little bit. You're seeing returns on assets across the board starting to decline on a year-by-year basis. And so the question is, how long and how hard will that translate into impacts on real economic activity, as folks see their sort of wealth that they had on paper really increase over the pandemic start reversing. So I think that's the big risk there. And I think you're spot on here. This really exposes the intellectual fragility and incoherence of MMT and these sort of far left theories, that you can just spend as much as you want and we'll take care of the inflation through taxation. Because if anything, there's just no political will for that. The idea that any politician is going to do that is, it strikes me as fanciful, and this really lays bare that idea that you can do that even on paper.
So let's talk about that for a second, Garrett, just because I can't resist. So the current proposal is, let's tax billionaires on their appreciation. And now I have my opinions, but seriously, does that have any impact on inflation by taxing billionaires?
Yeah, so what you see is, of course, most billionaires became billionaires because they have most of their wealth invested in the economy. They're not spending it from the consumption side of things. And so by increasing taxes on very high earners, especially folks like billionaires, you're not going to see a huge decline in demand, because most of that money is invested elsewhere, not being consumed. And so all it's going to do is actually reduce our growth potential moving forward and investment opportunities without a corresponding reduction in inflation, which actually in some ways could magnify this stagflation phenomenon we're seeing.
Right.
I mean, more growth right now, not less.
Obviously, it puts a lot of pressure on asset prices, and it will bring asset prices down, because if Elon Musk has to sell, for example, thousands of shares of Tesla in order to pay that tax, then obviously that puts downward pressure on the stock market. So that's true with Apple. That's true with everybody else. So to me, it's a downward pressure on asset prices, but it doesn't do anything for inflation, because those aren't rich people. In my experience, don't spend less money during inflationary times, and they don't spend more money during inflationary times. They just spend the same amount, because there's only so much you can spend anyway, right? So in order to actually make that work, the MMT folks would have to hit the people that they gave the money to in the first place, which is they have to hit the middle class. And like you said, there's no political will for that. That's clear. So this whole dialogue right now, we're going to tax the rich and that's going to stop inflation. I mean, that's just doesn't make any sense. And if they did tax the middle class, it would actually be cheaper. So my view is, and I'd like your opinion on this, but my view is it would be cheaper to the middle class to pay a higher tax than to continue inflation.
Yeah, that's actually a really good question, especially when you think about how damaging the inflation has been for middle class folks, and especially if we think about the trade-off of what we did, sort of the reverse of what you're saying, by taxing them, which is providing all of this stimulus to them. It did help folks in the short term, but now over the long run, some folks are worse off because they've already spent that money, and now they got to deal with this long-term inflation. Because one thing about inflation that folks often forget about is inflation, prices go up. They very rarely, if ever, go back down. It's not like we're going to see the price level decline dramatically on a permanent basis moving forward. This is the new set of prices. We saw this in the 70s and 80s, right? Prices went up, they didn't come back down. Just the rate of increase declined. And so that makes it pretty challenging for folks trying to catch up, and raises a good question about the trade-offs of did we overshoot with the pandemic relief, especially with last year's American Rescue Plan that it put something like 5 times more money into the economy than the output gap to get us back to full employment. And so we almost overlearned the lessons of the Great Recession, right? Where we had a really slow recovery and folks were worried about a lack of demand. And we used that and we went overboard, and now we're back into a different set of problems.
Yeah, shocking that the government overcompensated. Just
right.
shocking.
Yeah.
So I have one more technical question. I want to get into some practical issues. My technical question is: so before we saw commodity inflation, we saw high asset inflation. We saw it in the stock market. We saw it in housing. We saw it in multifamily housing. We saw it really across the board, asset prices. We even saw it in things like crypto, where you had a big upward pressure on asset prices, which long predated the commodity inflation. Okay. Does that mean that the asset prices will also drop faster than the commodity prices?
Yeah, I think that's a good question, because what's interesting about the current economic dynamic with both sort of broader asset prices and commodities is we have a mix of sort of changes in the financial situation with the Fed, and then we also have, if you will, real economic impacts from the Ukraine crisis, of course, is driving up commodity prices, not just oil and gas, but also things like wheat and other exports from those countries, as well as, of course, other supply shocks from, for example, the Omicron wave in China and some of their attempts to maintain COVID zero there. And so that's going to have, basically, you see the aggregate effect of the net impact of all of those different trends in both of those classes. I think that the big picture thing you're seeing overall with sort of asset values is, of course, as interest rates overall have declined, real interest rates have declined over the last few decades. That, of course, mechanically raises the present discounted value of those cash flows for those investments. And I think the worry is, or the uncertainty is, how much of this increase in rates is going to be a short-term effort to combat inflation, and the trend is still going to remain low moving forward, or are we seeing a structural reversal, which would be a major shift in the way we think about economic activity moving forward? I think that's the big picture question. A lot of folks
I mean, are we gonna kind of limp along at 5% cap rates, or are we gonna all of a sudden see 10% cap rates again? Right. I mean, that's effectively what we're talking about, because you're talking about price multiples, which is how all assets are valued. So let's turn to the practical side of this. So we're talking to CPAs here, and we have clients, and they're all concerned about inflation. We're concerned because, frankly, the reality is we have to raise our prices because we've got a lot of upward pressure on our salaries. Okay, right now. But how do we actually go about helping entrepreneurs? Well, how do you serve entrepreneurs in a way that they can help combat inflation?
Yeah, I think that's a great question, and it's challenging the tax code because we did make some progress in terms of indexing certain aspects of the tax code for inflation, most notably in '81 when President Reagan came in. But the job is far from finished, and we have a tax code that is a mix of provisions that are indexed. Most people know that, for example, the ordinary schedule is indexed, though not perfectly, right? We saw about a 3% adjustment this year that doesn't necessarily reflect the actual inflation that we saw over the last year. It's sort of lagging, but that's better than nothing. But we have a lot of other provisions, most notably, of course, appreciation and capital gains that is not indexed at all, in which you will be paying more if you're successful in a given year and realizing those gains, because a big part of those gains, more so than before, is now in the form of inflation. That's especially true as inflation maintains itself over the long run, right? I mean, any one year, if it's slightly elevated, that's a hit for these folks. But if it's lasting many years, that compound effect is pretty dramatic when you look at the real returns that folks are getting after tax if these various provisions are not indexed. I mean, other examples include, of course, the net investment tax threshold is not indexed, which means folks nominally are getting more and more folks are getting kicked into that extra 3.8% if on their passive.
I don't know. Sounds like AMT to me.
Yeah, exactly.
That's what happened, right?
More and more folks are getting thrown into it over time. And then you have other provisions like for a lot of individuals, of course, and this is really important thing right now with the house values, right? Is the capital gains exemption for homes is not indexed to the home mortgage interest deduction amount, the maximum amount of $750,000 of principal on your mortgage. That's not indexed. So more and more folks are going to hit those limits, and that's going to cause you paying more taxes in the long run. So that's been a big focus of ours, is to emphasize to policymakers that we really need a rationalized tax code that actually does provide that is a coherent and consistent treatment of inflation, so folks can be protected if we do run into this type of situation again.
So let me ask you another question. So, now we have a lot of discussion back with Joe Manchin, and the Democrats are talking about raising taxes and raising corporate taxes. We've got this horrible idea from Liz Warren that we need to actually let FASB determine our tax laws, right? The proposal to tax book income, which is basically just relegating or dumping your job as in Congress, dump it on FASB. That's like the dumbest idea ever, I think. But Treasury, we have higher collections than we've had. We've got this surplus going on, right? I mean, all the states are showing the surplus. Treasury showing the surplus. Why raise taxes when you have a surplus? All the states, I mean, literally, even California is looking at giving money back, right? So you've got all the states lowering taxes, giving money back, and now the Fed, no, they don't want to give money back. They want even more. So how does that play in? How does that play into an inflation and how, what it does to the average person?
Yeah, I think you're right to point out there's a strong disconnect right now between what states are doing on the tax side, which is trying to lower taxes, provide more relief for folks. The way they're doing it can vary across the states, but red and blue states are looking at that. And the Democrats in Congress and the White House are looking at going in the opposite direction, which is unfortunate to see. And as you say, we've actually looked at some of the numbers from the Congressional Budget Office and the Office of Management and Budget on where the revenue situation in the federal government is. And right now, last year we hit record corporate tax revenue, elevated individual tax revenue. We're on track to hit a record again this year, both in nominal terms, but also as a portion of GDP. And I think that's important. So even if you take out the inflation angle, we are still doing really well from a revenue perspective. The problem is, of course, policymakers want to spend above and beyond even that. And that's mostly why they are looking at these tax hikes. The problem is, I mean, a lot of folks will say it costs nothing, but they neglect at very minimum to say that there's a timing effect where they're planning to spend a lot of this money up front, but not raise a lot of this revenue until later. What does that translate to for everyday folks? More inflation in the short run.
Well, on top of that, let me ask you this question. So if we have the highest, so we're at a 21%, excuse me, we're at a 21% corporate tax rate, the lowest we've ever been.
Yep.
Or at least in recent memory. And yet we've got the highest collections ever. So it would seem to say that Art Laffer was right. I mean, right? I mean, supply side economics works. That's the whole Laffer curve, right? So that would seem to say that that's right, which would also seem to say that if you raise the rates, you actually jeopardize those collections.
Yeah, I think the doomsdayers in the 2017 tax law discussion that thought that lowering this rate would collapse corporate tax revenue, at very minimum, proves that they were wrong on that. And they, of course, neglected the fact that we broadened the base there, which we know from basic economics from the supply side theory that's going to help encourage more investment and ultimately in the long run more revenue. No matter how you slice it, I think right now, of course, the record revenue is a mix of things. I think inflation plays part of the role. The recovery helps, and then I think it is this pro-growth sort of direction that's helped maintain these revenues. And also, when you look at it from a historical perspective, business tax collections overall are right on track with where they have been historically, if not a bit up. So this argument that somehow businesses are undertaxed or we have a broken corporate tax code is just not correct. It's also true when you look at it compared to other countries. You'll hear a lot of these folks point out that, we have low corporate tax collection compared to, say, countries in Europe. That's just straight up wrong. We're actually, if anything, a little above average there, especially when you incorporate for the fact, as most of your listeners know, that we collect a lot of taxes through pass-through firms in this country. That's actually fairly unique. A lot of other countries don't have that or as much of that. And when you adjust for that unique fact about the US, we're sitting actually a little above average even now. So important fact to keep in mind.
on top of that, you also have to adjust for the fact we have state taxes, and most other countries do not have state taxes. Now, Canada does, but really a lot of Europe, they don't have those same state taxes that we have. They have value-added taxes basically instead, effectively. So, but from a pure corporate tax rate, our corporate tax rate is really not 21%, right? Unless you live in, well, I don't know.
Both states don't have them.
South Dakota, because Florida has a corporate tax. Texas has a franchise tax, so they still have a tax. So you know the
average is about a little over 25% in the U.S.
Exactly. So it strikes me when we think about how to help our clients. I've always said that the fastest way to put and easiest way to put money in your pocket is just lower your taxes. Just follow the tax law and lower your taxes, because there's so many opportunities that are legal that actually are encouraged. You know, whether it's real estate or, you know, whatever you're investing in, agriculture, business, whatever, that's the best way to actually get more money is to not pay so much tax legally. But what other things do you think, you know, as a business advisors, what should we be telling our clients to help them have enough money in their pocket to combat the inflation side?
Yeah, I think one area we've been looking at, and some of this is more so educating policymakers than anything, but I think it's important for firms and business owners to keep in mind too, is as inflation goes up, especially as I say, if it remains durable over time, hopefully it isn't, but if it is, the way the tax code treats depreciation deductions is gonna be impacted as well, right? In a world in which inflation is lower, you know, the cost of having delayed deductions, while still positive, is lower than in a world in which you have higher inflation, right? And so if you have a deduction, you're depreciating something over, say, 10 years, or with structures, you know, 27 and a half or 39 years, that makes a big difference if we don't have a tax code that adjusts for that or allows for accelerated depreciation.
And we have bonus depreciation starting to deplete starting next year, right? Goes down 8%, 60%, 50%. Do you think then from a policy standpoint, it's important for them to bring that back up to 100%?
Yeah, we've been big advocates of extending and even making permanent that bonus depreciation. We think it's an important appropriate part of our tax code. It also has a lot of simplification, of course, associated with it. If you could do that rather than having to maintain the various deductions on your books for tax purposes. And we're also following, of course, more narrowly the discussion that's happening right now about the switch from being able to expense R&D expenses to amortizing them over 5 years or up to 15 years for certain investments. Which we're hopeful, cautiously optimistic that maybe this year that can be reversed, because we're so unusual in doing that. First time since back to 1953 that we don't allow for R&D expenses to be immediately deducted, and we hope to do something similar for bonus moving forward. Of course, that was made temporary in the Tax Cuts and Jobs Act. Ideally, it would be made permanent. That's when we see the most pro-growth sort of effects from it. It also helps businesses who are making investments now and trying to understand, if I'm planning an investment out the next 5 years, what is the tax treatment going to look like? There's uncertainty right now. It'd be best to have that certainty in the form of permanence. So we'll have to see how that shakes out with the other tax discussions. Okay,
so final question. How do we deal with this from an estate planning standpoint?
Yeah, I think that's a really important question, not just with inflation, of course, but also with all the other sort of discussions on the Hill and in DC about changing various tax rules that would impact estates, not just the estate tax itself, but also the treatment of step up and basis, which we had a discussion last year about potentially repealing, and other more complicated proposals from other folks that Senator Ron Wyden this year to basically implement a form of mark-to-market taxation of capital gains that would impact estates. But and I think this goes back to the big question as to how long this inflation lasts, right? Because a temporary blip of a couple of years is one thing. If this thing is durable and lasts a long time, all of a sudden, if you are trying to plan over a long-term horizon and plan out your estate, that makes a big difference, right? When you're looking at your
you better freeze those values now, and then on top of that, remembering that the $12 million exclusion drops.
Yep.
It's also temporary, right?
That's a great point, right? So that does adjust every year, but it is going to cut in half effectively at the end of 2025. And so folks, that's another reason why I think, no matter what direction we take in terms of the policy, a lot of folks would prefer permanence and stability and certainty over an uncertain code. And that, of course, for a lot of folks, a lot of your listeners, is put a lot of stress on folks the last couple of years who just don't know where the tax code is going. It's a lot of whipsawing back and forth. It'd be better to have permanence no matter where we land than that additional uncertainty. They're already getting a lot of that uncertainty in the market and with inflation. They don't need it from policymakers too, who can't make up their minds.
Awesome. Well, thank you, Garrett Watson, Tax Foundation, taxfoundation.org. I'm a big fan, as you know. I get a lot of information out of Tax Foundation, and it's really, really helpful, both on the federal side and the state side. Any final words for our listeners, Garrett?
Yeah, I just want to thank you again for inviting me. And we are following closely all the developments, not just on inflation, but on the various tax proposals in DC through the rest of the year. So feel free to come to our website, taxfoundation.org, and peruse our materials. Not only do we have analysis of proposals that are happening now, but also a lot of just tax education. If you have a friend or someone who wants to learn more about the basics of our tax code, we're the place to go to.
I really appreciate that. Again, Garrett Watson, the Tax Foundation, taxfoundation.org. Just remember that, our clients do care about inflation, and they do care about what's going on from a tax standpoint, the inflation. And when we look at the combination of the Tax Cuts and Jobs Act and the evolution of that over the next few years, and we combine that with inflation, really the best thing we can do for our clients is to help them permanently reduce their taxes. And when we do that, we're going to find we have better clients, a better practice, and a better life. We'll see you next time.
You've been listening to the WealthAbility for CPAs show. Better clients, better practice, better life. To learn more, go to wealthability.com.